Hello and welcome to Rentals with Rachel. Today I'm talking with Tim Kleyla of the Mortgage House in Holland, Michigan about some special investor programs that he runs for loans. So with that, welcome Tim.
Hey, thank you, Rachel.
So tell us a little bit about how you got started in the mortgage business and what types of loans you like to work on.
Okay. I actually started in the mortgage industry. My mom gave me an offer that I couldn't refuse. So it was actually my mom and I started the company in 1991. She retired about 10 years ago. I actually came into it and absolutely love it. I came out of Hope College with a degree in business administration. And so this was what I was meant to do right from the beginning. We do a lot of loans with first-time homebuyers, investors, self-employed business people. I do a lot with that, people that are looking to branch out and expand their horizons with different kinds of properties and stuff like that.
Okay. So can you explain the difference between a mortgage broker, which you are,
Yep.
and a typical mortgage company or a bank that does mortgages?
Yes, absolutely. So when you look at the way the industry is set up, you've got depositories on one side and mortgage lenders, bankers and brokers on the other side. So let's look at the whole picture there. The depositories are your banks and your credit unions. Okay, they're typically going to have one product that they have available, a set of guidelines. They may offer conventional, some FHA, possibly VA, maybe USDA, maybe just conventional. And those guidelines tend to be a little bit more conservative because of the rules that they're under with the FDIC and stuff like that. On the other side, you've got mortgage bankers and mortgage brokers. The difference there is also very similar in the respect that the mortgage banker is going to have a limited number of products that are available to them because they're selling off to one lender. So they're selling off to maybe Fannie Mae or Freddie Mac, something like that. Whereas a mortgage broker, we go out and we look at all of the different products that are out there for our borrower and try to bring those products to our area. So at any one time, we may actually be working with anywhere from 12 to 15 different lenders, or possibly more than that, depending on what our clients need.
Okay. So as the consumer, what kind of benefit does that offer to me?
What a recent study was just done by UWM, the largest lender in the country, and it showed that the average consumer saves about $11,000 by going through a broker over the life of their loan.
Wow, that's
Yeah.
a significant amount of money.
It is. One of the other benefits that people find is the products that are available to them. So what we will do is we will very typically go out and take who our consumer is, what are they looking for, what kind of product is going to be the best one for them, and we try to find a lender that matches that for them. So as opposed to trying to find or trying to take our borrower and shoehorn them into a product that's available with one lender that may not actually be a great fit for them, we will actually try and find the lender that fits the borrower the best. So in the context of what we're talking about, that may be an investor that wants to go out and purchase 6 houses all at once. So there are lenders that will do that, but not all lenders do that. So we have to go find those specific lenders for those borrowers.
Okay, got it. So what would you say is different for an investor when they're shopping for a loan as opposed to, let's say, a first-time home buyer?
The investor is going to be more concerned with cash flow. What is coming in on this product versus what's going out, different investment strategies for that product. Whereas a first-time home buyer is concerned about cash flow as well, but it's not what's coming in from the property, it's what they've got coming in from their employment and how much we've got going out. The first-time home buyer also is a lot of times going to look at it much longer term and as a different kind of investment. So I'm purchasing this home as a first-time home buyer. This is my first home. We're starting our family here, and 5 or 6 years from now, we may need to move into something bigger. So where is this house located? What school district is it in? Do I like the neighborhood? What are things important to me as far as my lifestyle is concerned? So if I like working on cars, for example, does it have a 2-car garage or does it maybe have a pole barn? Where my investor is not necessarily as concerned about those things, because what kind of income is that property going to generate? So my first-time home buyer may say I want to do a single family, and my investor may say I want to do a 4-family. because that's going to generate better cash flow for me on that property than the single family would.
Okay. So is there also sometimes a different down payment amount or different qualifications for an investor?
There are, and that goes to a lot of the different kinds of products that are available for investors as well. With our first-time investors, there are products that are available where you can actually use the income that's being generated on an investment property to help you purchase that property. So one of the mistakes that people make is they think I have to be able to afford this by myself on just my income. And that's not necessarily true. If they're purchasing a single family investment property, they can do it as little as 15% down. And then when they do to the 3 to 4 family, they can do as little as 25% down, okay? Where the non-Fannie Mae and Freddie Mac products will allow them to go as low as 15% down, again, depending on the number of units on that. And then the way they purchase it can also be very interesting. So the Fannie and Freddie products are going to use the income that the borrower is generating and the income that the property is generating, where the non-Fannie Mae and Freddie Mae products will offer things like a DSCR loan, which is a debt service coverage ratio loan. And that's where we look at the income that's generated by the property, and that is the sole point of income that's used to determine if the borrower can afford that property. Okay, so it's a very different look. It's a much more commercial look at how that property is being used and how the income is generated and how the debt is serviced.
Right, and it's my understanding that even a short-term rental property can be done with a DSCR. Is that correct?
Absolutely correct.
Okay.
In fact, because those products are relatively new, there have been adoptions. The adoptions have been coming, and we're seeing more and more lenders that are using those short-term rentals as the short-term rental income as acceptable income to purchase those properties.
Okay, that definitely opens up a lot more possibilities for investors, I think.
It does, absolutely, because we're now not looking to see, all right, we don't need to have that 6-month rental agreement to be able to purchase that property anymore. We can look at the short-term rental stuff.
Now, when you're looking at DSCRs, are you also looking at forecasted income or only proven income?
On the DSCRs, what typically they will use is the rent schedule that's put together by the appraiser. So the appraiser will actually go out and do an evaluation of other like properties, even if this one isn't currently rented. So other like properties and what they rent for, and then we use that number to determine the rental income property for this property.
Okay, so it can be pro forma.
Correct, yes.
Okay.
Yep.
So when you and I have talked before, you've mentioned that you have some specialty loans for investors, and I'd love to hear more about those.
Yes.
For example, you said you had a fix and flip loan.
Yes, we've actually got fix and flip to keep and fix and flip to sell, and they're going to be handled a little bit differently. So one of the things to keep in mind is that when a lender is making money on doing a loan, if you hold the loan longer, they will make money for a longer period of time.
Sure.
So if you're doing a fix and flip to sell the property, they do tend to be a little bit more expensive upfront because that's how the lender makes their money. However, having said that, they will allow you to go into it and they will actually lend you the money to do the fix. So then you're just responsible for finding the property, having a contractor, getting the bids together. They'll help fund that, and then you can actually sell the property after that and make your money, and then move on to the next one. After you've done a couple with them, a lot of these lenders will actually start to set up a line of credit with you so that you can put them on and take them off for a smaller fee. But because you're starting to do them now with them a little bit more often, they actually sort of get involved in that with you and start to set up those lines of credits.
Okay.
Yeah.
So does someone have to have anything in particular to qualify for that?
Well, depending on what they're looking at, you're not going to get the line of credit right off the get-go.
Sure.
So we got to do 1 or 2 of them to get started. But beyond that, just the spirit to go give it a try, to get out there and try and make it happen. And using somebody like yourself to identify those properties that are going to be the good potentials for that, something that needs to be fixed up that then has the potential of increased rental incomes and that kind of thing.
So is the lender then also looking at the ARV, the after repair value on the home?
Yes, absolutely. And in a lot of those cases, what they'll do is they'll actually reduce the amount of money that you have to put down if the repaired value of that property is high enough. So they may do something where they're at, instead of putting 10% down, you may be able to put 7.5% down if you've got a 25% equity position after the property's been repaired.
Wow.
Yes,
Okay.
absolutely.
Yes, that's a huge thing. I mean, it's hard enough to find, flippable properties as it
Right,
is,
yes.
and then to try to get financing to be able to pay for the repairs is another thing.
Yes, yep, absolutely. The other thing that's available is to do what's referred to as a blanket loan, where you go, okay, I'm going to start to accumulate these properties, but I don't want to have 6 different payments. I don't want to have to be able to go through this loan 6 different times. They will actually allow you to put a blanket on those properties and have them all covered under one loan.
Okay.
Okay? And one of the things that we haven't talked about yet is anything beyond 4-family. So those are available too. Now, those aren't going to be able to go through the residential product, but that's a commercial loan, but you can go 5 to as many units as you want. And a lot of those same products are available. So you can do fixed to rent properties and have the cost of the repair included into the financing.
Wow.
Yeah.
Okay. Now, what about for flippers that like to do a lot of the work themselves? Is this not a good option for them?
Not necessarily, although what we may do is look in a different direction with that. So what we may do is we may take a property that's already been completed, whether it's their primary residence or an investment property or second home, use an equity line on that to do the repairs on the new property. Once the new property is then done, you do the refinance on that one, pull the money back out of it to put it back on your equity line.
So for an investor who maybe found out about a group of homes that were for sale, like let's say a group of 12 houses under one seller,
Yep.
how would they go about purchasing that?
That is a really good question. That is a perfect example for a blanket loan.
Okay.
So what's going to happen is that lender is going to put a lien on all of those properties together, but the loan comes together as one loan to cover those properties, okay? Typically what's going to happen is if the borrower then wants to sell off those properties, the property is sold, it is then reduces the loan amount on the remaining balance of that loan, okay? Now, some lenders will actually allow them to put new properties into the blanket loan, and they will expand the loan amount on that. So it allows you to take it in and put it out. Kind of a big idea of almost like a line of credit, but it's set up more to the borrower's advantage because it's not going to have the short-term interest rates on it.
So that they end up only having one payment too, which is nice.
They end up only having the one payment, yeah.
Okay.
Yeah, and it's a great scenario for like a small resort. You know, there are a lot of places where you've got, several cabins, and we're looking at doing something like that. Or we've got an investor that has put his own portfolio together, and you've got a property here and a property here and a property here. So as opposed to having to go each and spend the money to do each one of those separately, you can do it all as one.
Right. Now, I've also heard that sometimes that if people use a portfolio loan, if they then sell off a property, then the whole loan comes due. So you're saying that that's not necessarily the case?
Correct. Not necessarily the case, yeah.
Okay.
That is typically more like how a bridge loan would work.
I
So
see.
a bridge loan bridges the equity from one property to another property, and once this one sells, then the whole thing has to be paid off, and you've got to start over again.
Okay.
But the blanket loan typically doesn't work like that.
Nice. Okay.
Yeah.
Now, what about doing new construction? What if a buyer wants to buy some vacant land and do, ground up new construction?
Let's go.
Okay.
Yes, we have we have lenders that can do all the way from the purchase of the property all the way up to the construction, and you can do all the way up to a 4-family on it as well. So yeah, new construction is out there. You do have to have a contractor, and if it's something that you're considering, we would actually like to get the contractor started, get the approval for the contractor started first. Because then he gets that part of it done, and then when the bids start to come in, and we can start putting it together for you very quickly that way.
Nice. Okay.
Yeah.
And is the payment of the plot of land included in that, or is that a separate purchase?
Well, you can handle it either way. So you can purchase the property, and that's sometimes what you have to do is you've got to identify the property and jump on it. So you get your land loan, you can do that separately. With the construction loan then, the very first draw of the construction loan pays off that land loan, okay? Or if you've already got the builder approved and you know what you're going to build on that property, you can just purchase it all at once and have the closing on the purchase of the land loan happen at the same time as the construction loan.
Okay. And then what about down payments in that situation? Is that?
You can, if you're doing an investment property, the 3 to 4 family is going to be the 25% down, and you can do the single family all the way down to 15% down.
And what about doing multifamily properties? If someone wanted to buy, let's say, a fourplex and they want to fix it up maybe and then continue to rent it out?
Yes, absolutely. Again, the fixed to rent program would be perfect for that scenario. And again, the 92.5 loan to value with the 75% loan to cost.
Okay.
So actually they can do it very, very affordably.
Okay. So my guess is that a lot of investors are not familiar with a lot of these programs that you have.
No, they're not. They're familiar with you have to have this much to put down because this is what Fannie Mae and Freddie Mac require.
Right.
They're not aware that the DSCR programs are out there. They're not aware that the fix and flip or the fix and rent programs are out there. And it's unfortunate because it's a great way to expand your portfolio. It's a great way to bring extra money in. It really encompasses the spirit of moving forward with controlling your own destiny, so to speak. Where I'm investing where I want to invest. I'm investing in my neighborhood. Right. I'm investing down the street. I may be investing in putting my kids in one of the units.
Yeah. I know you had mentioned that to me too, that you had some specialty loans for homeowners that may not be necessarily for investors, but about putting family members like aging parents or something.
Yeah, so one of the interesting things is that Fannie Mae has a program that allows you to purchase a home for an elderly parent or a handicapped child as a primary residence. They don't necessarily have to be on the mortgage or the deed, but you establish the fact that they have that need. You can do that mortgage for them and have them live in that property, and you get all the benefits of doing it as a primary residence.
Nice.
Can't do multifamily on that one. Has to be single family residence.
Okay.
But if you've got a child that is handicapped and can do that, then by all means.
Okay, great. And what would you say are some ways that an investor can set themselves up for success when they're working with a lender like you?
One of the first things they can do is start to gather their documentation. So one of the first things when you meet with a lender we're going to ask for is going to be your personal tax returns. If you own a business, we're going to ask for those as well, covering the last 2 years typically. So W-2s, tax returns. If you have investment properties, we want to see all your schedules to see how those are being handled. Having your assets together. People will start to move their assets around thinking we have to have it in the checking account or in the savings account. If you do that right before you purchase, we need to track all that stuff down. So we prefer that you just leave it where it is. Yeah. And then we can liquidate and do stuff like that as necessary when the time comes. The other things that they can have ready is what their expectation is, questions. We love when people ask us questions. Especially if this is your first property, your first investment property, having questions for us helps us structure what you're trying to do. And that can be important. Some people want to hold a property for a short term. Some people want a property to cash flow immediately. For the first 20 years that I did this, investment properties didn't cash flow when you bought them. You had to wait 5 to 10 years to do that. And then we would say, go talk to your CPA because he's going to tell you about all the stuff you get to write off, which is actually going to help make this a more doable project for you. Yeah. Right now, we're in a time and a place where you can actually go buy a property and it potentially is going to cash flow right from the first day.
Right.
So it really is a very different place right now than where we were even just 10 years ago as far as investment properties are concerned. So, but having those questions really does help you figure out what the best way, which one of these loans is going to be the best one. We may have 20 different loans for us to look at.
Right.
And depending on who you are and what we're trying to do and where you want to go with it, it helps to narrow down those loans. It helps us to go, okay, these are the two best ones for you.
One other thing that can come up, obviously, is that somebody might be self-employed. Maybe if they're doing flips, that is their job.
Yep.
So how do they get a loan?
Well, again, we start with the tax returns. And if we've got verifiable income that we can use by going through those tax returns, that may be the best route for us to go. On the other hand, we may look at a bank statement program, for example, where we look at how much income is coming in over the last 12 months into your bank statement. We take a percentage of that number and we use that potentially as your income. The DSCR loans are another great way to look at the income that can be used that may not be actually on your tax returns. So the debt service coverage ratio loans, more dependent on that specific property as opposed to your income overall.
Got it. Okay. So somebody who doesn't have a typical W-2 is not out of the running.
They're not disqualified, no.
Okay.
Yeah, we actually pride ourselves on working with a lot of people that have challenging income.
Okay.
Yes, absolutely.
Great. Yeah, I think that's a common concern for a lot of folks, that they
Yeah.
won't qualify for a loan because of that.
Correct.
So,
Yep.
yeah. Okay. Is there any other recommendations or suggestions you would have for investors?
Have a good CPA. Have a great realtor. Because that's very, very important. You've got to be able to identify the areas, got to be able to identify rents, you've got to be able to identify what needs to be done to be able to help the amount of the rent. Look at projections forward. That's always important. The rent on this property right now may be X, but if we do this and this and this, it can be X plus, right? Those things are important to look at as well.
Okay. Wonderful. Well, thank you so much for talking with me about this today.
My pleasure. Thank you very much for having me.
Yep.